Okay, folks, welcome back. All right, so I appreciate your patience. I had a little bit of a technical difficulty today. We had issues with the routers in pulling the internet into our office, so I had to go get a router, and it proved a little bit difficult to do. So anyway, here we are. I want to talk a little bit about the continuing conversation I had in regards to what's more important, your profit target or getting paid. And I want to kind of like move into what I was really directing your attention to in the Aussie dollar the other day. I drew your attention to the 60-minute chart on Twitter on the 28th. Okay, so the market was rallying up in here, and we had relative equal highs. You all know what that is. And one of the questions I want to answer that I've gotten from several people that just made it into the latter months of the mentorship. And one of the repeating questions is this. And you may have obviously had this question earlier on, but I want to talk a little bit about it now because it's germane to a recent opportunity or event that took place in the Aussie dollar. And I want to talk about the times or reasons why when we look for low resistance liquidity runs, like relative equal highs like this, we're expecting price to run above that and attack the buy side liquidity. And you're going to be met with this at some point, and whether you're trading with live funds or whether you're still practicing with just paper trading or even demo trading, the event, okay, is going to be met by you. You're going to be seeing this as a problem. And I want to kind of like teach you how to anticipate it versus where you see a low resistance liquidity run that just makes it run right through these highs, and what it is that usually, not always, but most of the time, creates a little bit of a delay or a retracement ahead of running those highs out. Now, recently in the commentaries, I've talked about how the difference between a high with a higher high and then it breaks down, those both being relatively equal versus this high and this high being lower, but again, still relatively equal. So both of these highs here and here and here and here are underneath the umbrella of what I call relative equal highs, but they're not the same. Okay, they're not the same. And I want you to understand this, and this is really the whole point of this weekend price action lesson. It's important. So when you get done watching it, don't think that, well, that really wasn't much. If you go back through the charts, like I'm going to tell you to do now, and look at this, you'll see what I'm showing is true. And it'll help you understand how the market will do what I'm explaining here. Okay, and how to avoid getting disappointed or disgruntled about a trade not panning out as fast as you would like to see it happen. All right, so we have the run on the optimal trade entry, and look at this here. You see that? That fair value gap is very important. This fair value gap is more important than any fair value gap that would be on a lower high like this. Okay, so you have a fair value gap. It goes up, just about closes in here, but notice when you get back up to it this side, it just rolls right on through it. Whereas over here, price trades up into it and then says, I got to come back down. That's really important. There's one more thing that goes along with this that makes it imperative that you understand. Anytime you have relatively equal highs, okay, like we have here and here and even here, okay, when you have that, you're going to be looking for one to the right. It's this one here. In other words, this to this is the higher one. Whenever you have a second high being higher than the first, they can be relatively equal, but if this is going to be higher than this high, you have to treat it a little bit differently versus this high and the lower high here. These relative equal highs are much easier and have a lower degree of resistance for the liquidity that rests above it versus the higher high of the relative equal highs being here. In other words, the second high versus the one to the left, okay, if you're looking at two equal highs or relative equal highs, the one on the right, if it's higher than the left, you're most likely going to encounter what I'm going to teach you here. Now, it's really important that you understand that even though that this may be true, the higher high is on the right and the lower high is on the left, you still can get a relatively equal high, low resistance, low liquidity run like that and have no problem. But what I'm going to teach you in this lesson in relationship to the euro dollar, it'll help you understand relative strength analysis. It'll also teach you what makes these highs hard to run through the initial time it goes to it, like it does here, and then it has to retrace deeply, but then ultimately comes back and takes it out. So I'm going to add some annotations here, and again, the lesson is when markets resist running old highs. Now, it doesn't mean it completely rejects the idea of it and never runs it, but what causes the market to not want to run those equal highs? And if you have a trailing stop loss, you can get stopped out, or if you hold on to it too long and if you bought too high, it could result in pressuring you to get out with a loss and collapsing the trade and ultimately seeing it go in your favor. And if you've been trading for any length of time, you have experienced that, but you probably never understood what it was that was going on and what led to all of that. And that's what I'm going to unlock for you today. We're going to look at previous highs here again, but I'm annotating the fact that we have lower high here and higher high here. But we broke these relative equal highs with this run here. Now, the buy side liquidity resting above the higher high, that is what's being attacked here. All of this run here is a more aggressive or deeper raid on the buy side liquidity versus that of the euro dollar. Now look at this for a moment before I show the annotations, and I'll go back to this chart again so you can see the times on the 20th and the 26th to the 27th. Now in relationship to that, you see these highs and the price action over here. What in this price action is different to that? Well, let's go to the euro dollar and look at it. Here is the higher high, but do we have a fair value gap in here? We only had one that was immediately traded to here. So even though we have a higher high on these relative equal highs, when we traded back up to this level in here on the fair value gap, it just kept pressing through, and then only just small retracement into here, but not breaking the higher high relative equal highs yet until we get to here. But notice that it's only a shallow raid above the buy side liquidity pool here. Now the buy side liquidity pool is defined by the highest high in the relative equal highs. If it's a single high, then it's obviously defined by the highest candle. But you're using the highest of whatever the relative equal high is. But look closely. We have a shallow raid above the higher high of these relative equal highs. So this was just a very, very small, shallow run above the highs. And then it had to do what? Retrace back and dip down into a bullish order block. All of this area here, this sells what kind of narrative? That this was a false breakout, this was resistance, so now trust it going short. Especially if it trades back up to this point here, then retail traders can do what? Short it. But that selling provides the counterparty to smart money buying it when it trades back down and again into the bullish order block here. So we had a bullish order block here and a bullish order block here. Optimal trade entry, trades higher. Look at the relative strength in the euro here on the 28th of May versus that of the Australian dollar. Yes, Australian dollar did have a little bit of movement, but it hit this fair value gap that wasn't filled in until we traded up to here. So while it looked like it could easily go above these relative equal highs on this day here, the fact that we had a higher high in the relative equal highs, and let me take this box off so you can see a little bit plainer. There's that fair value gap there. So it rebalanced that point and then traded down. Why did it need to do that? Well, we had a much more pronounced run into the buy side liquidity pool above this higher high of the two here, because this high is lower than this one. So the buy side liquidity pool starts at that candle's high, and it's layered up in divisions of 10, 20, and 30 pips. This goes relatively deeper than that of the euro. So in terms of breaking these old highs, institutional order flow is bullish, but the market's going to want to rebalance once it starts to drop down. This is not a false breakout and collapse. It's going down to pick up more orders, and then it runs above it again, comes back down, picks up more orders, and then it's allowed to reprice to a higher degree. But the fact that we had a shallow run, in other words, it just went above it a little bit above this high here, whereas the Australian dollar did a whole lot more running higher. So it's at a very deep premium. So it has to go where? Back to a discount for smart money to go back in, trading back below the high and even below this high here to a point of a bullish order block and a discount. What's the discount range? Just the low to the highest high. It trades down, picks up more orders. Too late in the day to do much about that. Start a new day, and then it rallies up into the fair value gap here. When it has this signature in price, we have a fair value gap, higher high relative to the one to the left. In other words, we have relative equal highs, but it makes a higher high on the second one. That is going to be a formidable high. In other words, expect this type of event where it'll trade up into the fair value gap, and then it may not trade through these. It may need to retrace back down. Whereas you don't need to see that happen in the euro, because the euro didn't move to such a degree that it was at a very high premium. It just went above a previous high, shallow, and then retraced back down to a bullish order block, optimal trade entry, and it runs. This shallow run above the old high here is much less than all of this price action above here. So when we ran above, it was much more distance covered. Many more pips were taken in the Australian dollar into a premium level, causing it to need to move to a discount much more than that of the euro. So understanding that this fair value gap here, and I'll take this off now so you can see it, the fair value gap is where it trades up into. Then it needs to retrace back down. It could have ran through, but the chances of it doing that are diminished if we have this higher high and we run above old highs like this. And if it was a very shallow little run and it had a fair value gap in the high there, then it wouldn't make a big deal. It wouldn't be a factor. There's specific things I'm trying to communicate here that it's going to take a little bit of thought on your part, but as you go through your charts and you look at this happening, you'll quickly see right away that what I'm showing you is whenever you have the higher high, even if they're relative equal highs, if there's a fair value gap in there and we've taken out previous highs and it's been done in a manner like this where we moved a great deal in terms of pips versus the euro dollar where it hasn't really moved that much. It just was a small little shallow run, trades back down, picks up more orders, and then explodes to the upside. Whenever you have relative equal highs and the higher highs on the right and you have a fair value gap and you've already moved above previous high a great deal, it's going to want to retrace deeper than running quickly above the equal highs. Okay, so I'll show you the E-mini S&P, and you'll see that is another example of what I'm showing you here. But how do you look at price to see this? How do you study it? Go through your hourly charts, go through your 15-minute charts, and you'll see lots of examples of that over a span of 4 weeks. Okay, so 1 month, 20 trading days. Use your 15-minute chart and your hourly chart, and you'll study all of these types of signatures, and you'll see right away what I'm showing you here is not just one little cherry-picked idea. Okay, because every time I tell you something in the marketplace, for instance, like the fair value gap and or the consequent encroachment of these gaps or a volume imbalance, these signatures, the things I tell you about them, you are seeing, since I've taught you, you can see those signatures are in fact true. They're not contrived. They're not just built on, fluff. They're real things that occur. And what I'm showing you here is one of those events where I get a lot of questions about, like, how do you know when a high is going to hold and it's a turtle soup? If you are in a bearish environment, okay, in other words, if you thought that this market was in fact bearish and this event took place just like this, this would be a sell and get short when it goes up there and know with a great deal of confidence that this high would not be taken out, and then you could ride it for a longer term degree lower. But in this current environment where the dollar is weaker, this is setting up a stage that it wants to eventually go above these equal highs, but it doesn't need to do it the day it trades up to here. Expect some measure of retracement, which was along the narrative of me kind of asking you before all of this is even happening, what's more important, getting paid or your target? So everyone knows when I prompted them to look at the 60-minute chart that they had relative equal highs, but how many of you were noticing this fair value gap? Chances are probably not a lot of you, because you are all being primed for me to look at these equal highs with you and see them ran out. Euro had no problem trading higher on the 28th. On the 28th of May, the Aussie dollar did trade up, but it went right to the fair value gap, stopped dead in its tracks, and then had a deep retracement. Didn't unsettle the idea of running those equal highs. It just was met with more resistance, but still nonetheless going and eventually running it out. And I'll show you that did in fact happen. Right there. So we ran that, and then we had a retracement. Now, what does that mean? What does that mean for you, and why is it important? Well, there's going to be times when you think you see a relatively easy, low resistance liquidity run. But if you are looking at how the market structure has been broken and how it's traded above recent highs, how much of a move above that did we have? This was pretty significant. And then you contrast that with a correlated pair, because the euro dollar should go up when Aussie dollar goes up. We only had a shallow run here, and then it comes back down. Goes back above and creates another optimal trade entry here, bullish order block. So you have two areas of accumulation. This trade is going to be more dynamic to the upside versus this trade requiring a little bit more time, and it's going to lag. It still can move in sympathy with a weaker dollar, stronger foreign currency, but it just means that it's going to be met with a little bit more time requirement versus that of a market like the euro has the underlying relative strength to the upside. So again, the signature is this. A lower high on the right, when you have relative equal highs, that's the ideal low resistance liquidity run. It's going to be real easy for it to run that. A higher high to the right, when you have relative equal highs, that's going to be a little bit more energy, okay, or magnitude on the part of the market to get through those, especially if we've already moved a degree into a premium. So we're really above these highs already, and we had a sharp retracement. Then we can look at this. Is there any fair value gap in there? If it is, and we rally back up into that, be expecting that to offer some kind of tradable retracement. And what is a tradable retracement? When we traded back up into this fair value gap, don't just look at it as it's going to come back down and find some kind of a fair value gap in here. Not that there is one in this price action, but it's going to require a deeper retracement. And how do we do that? Well, we have the range low to the high that's created. 50% of that is where you're going to have equilibrium, and below that would be a discount. So you have to look at all your discount PD arrays in here to align with what would likely be a scenario where it could trade back down into before eventually running these highs. Whereas you don't have that problem or conundrum with the euro, because you had a shallow run here and it retraces. So you know what's likely to happen. A deeper run above this high and above the original high that we would expect buy side liquidity pool to be traded into and probed for the counterparty, because smart money has accumulated longs down here and down here. So where do they want to take their profits at? Above old highs, where there's going to be willing buyers to be counterparty to sell their longs to. And they only were able to get out here. So when it trades back down and rallies back above, they were distributing again. And when it came down again, started rallying hard, they were distributing as well, as we were trading above this high in layered buy side liquidity. For anyone that was going short here, their buy stops are all layered in here. Anyone that looked at that high as a buying breakout, the smart money can sell to those buyers on a breakout from the positions they took here, here, and here. And now in the optimal trade entry here and here, they could distribute those longs to the willing buyers on a breakout or protective buy stops above these highs. So when I look at charts and I'm looking for scenarios where I'm looking for a low resistance liquidity run, I take a lot of effort to see where are we at in regards to the previous highs, how we broke that market structure to the left. So we have a higher high here, shallow run here. So it's due for a more pronounced run higher. The Aussie dollar, we ran above these relative equal highs, and we moved a great deal in relationship to that of the euro. And we had a deep, sharp retracement. Then we found another opportunity to go long in here, and then the higher high here is a factor that we have to overcome. Now, it doesn't mean that it's always going to create an opportunity where it's hitting this fair value gap or a fair value gap in this leg right before the high, and then it creates a retracement. Sometimes it'll be just a small little retracement, and then the very same day still run back up. But if you're not expecting that, it could be unsettling, especially if you're watching on a 5-minute chart or a 1-minute chart. It could scare you because those charts will look fast. They'll look like they're moving a great deal and change your opinion when it really hasn't changed at all on an hourly or a daily chart. Okay, so I just want to, everything I said here can be reversed for when we have equal lows or relative equal lows. Whenever you see lows like this, like relative equal lows, but this low is lower than the one to the left. So that same scenario here is what's being described here, just on the low end. So if we were looking for a low resistance liquidity run to the downside, and if there was a fair value gap, which doesn't have one here, this same element of trading back to the relative equal highs, but the higher high, if we have a fair value gap, expect it to trade into that and maybe have a deeper retracement before running the equal highs out. That said, in the opposite terms, for when you're looking for a low resistance liquidity run on the downside, the lower low here is problematic, okay, in the sense that we may need to trade down into some kind of a fair value gap if it resides there, and then retrace a little bit deeper and then sell off at a later time below that low. So it's important to know that while it may not be this big of a deal in the trade, even though you do see that relatively higher high or lower low in relationship to equal highs or relative equal highs and equal lows, when you're using it for a framework for looking for a low resistance liquidity run and trying to trade to a point above equal highs when you're bullish or below equal lows when you're bearish, you have to consider what those highs look like, because it's better, okay? It's better when you create a high and it has the higher high on the right. They tend to be stronger, especially when you're bearish. Why? Because it's showing it's rating and rejecting the previous high. So when anyone that was short here, it runs it above that, they're no longer allowed to be short, but that buy stop they used is now counterparty to smart money adding more shorts, and then you get this quick move lower. So if you look at it on a 15-minute chart and an hourly chart over a span of a 4-week time, you will see lots of low resistance liquidity runs, and they'll also create this signature a lot of times when there's a fair value gap, when it has a higher high, that creates a scalp. And since you're looking at a 15-minute chart, that may require a patience factor that maybe you weren't expecting yourself to require in that setup. Maybe you were expecting it to go right on through that. Not if it has these elements. Okay, so it's really, really important you understand that. And now I'm going to go over to the E-mini S&P. All right, so here's the E-mini S&P, and I'll work backwards in this chart because I wanted to use this chart to segue into, because it's along the same lines as I was mentioning with the relative equal highs. So on the 15-minute chart, you can see we have this high and this high here. So on an hourly chart, it's going to look basically like what I just showed you on the Aussie dollar. So, but it's this high and this high here. And then we have this movement lower. What is happening right in here? It's the same thing I just showed you with the Australian dollar. So we have relative equal highs in here. This high being lower than this one. Did this run above these relative equal highs move a lot? No, it didn't. And price does what? It breaks down and it leaves a fair value gap. So now we have relative equal highs between this high and this high here. So any buy that you pick up down here on an order block that you'll see when we go to an hourly chart, and it starts rallying up, it looks like on Friday that this relative equal highs would be ran out. Look closer. We have a fair value gap in here. Price trades up into that, and today at the open on Sunday, we are down here. It's softer. Now, that's not to say that we won't go higher, and that's my expectation. I would rather see the S&P trade above. I think this is just a knee-jerk reaction to all of the protests that's going on around the U.S. But I believe, as I'll show you here, there's some things still in the chart that would need to be completely erased before bearishness comes in, because I think they're still trying to press it deeper into a premium. But you can see the effects happening even in the S&P here. Okay, so in an ideal world, we want to see relative equal highs that we're looking to run when we're bullish for a low resistance liquidity run, and that's mouthful, but we want to see a lower high there on the right. It makes it a little bit easier to get through. If you look at this high here to this high here, we traded down, yes, but then look what we did. We traded right on through it, easy. Relative equal highs, lower to the right, went through it, relatively easy. Same thing here, lower high, relatively easy. What do we have here? Lower high to the right. So this retracement may just be what needs to happen for picking up more orders inside the order flow in here, and then ramming this thing higher. If we bring in the other indices, the red is the Dow and the blue is the NASDAQ index futures. Okay, so on the 27th, you can see that the NASDAQ made lower lows, the S&P made lower lows, but the Dow was saying, no, I don't think so. It diverged. So that's your index SMT divergence, and it creates, when it trades down to a bullish order block, as we'll see when we go back out to the E-mini S&P chart, it shows the underlying accumulation that's taking place here. So all of this running down is a run below these equal lows. This is how I like to use the relationship between the Dow, the NASDAQ, and the S&P. So if I have equal lows that I think are suspect, in other words, they're likely to run those out. If it runs those lows, I want to see if it's a fake run lower to pick up more orders to go higher, which is what I would see that as, because we were expecting the S&P to go higher if we traded above the volume imbalance, which is that blue shaded area down here. As I said, I'll work out to a higher time frame daily chart and flesh all this out, but I want to show you how when I look at charts for index futures, okay, the way I see setups that happen every single week like this, these are just easy bread and butter setups that they're always in the charts. They're always every single week there. That's why I said, like, you're learning this because it will give you the same ease at your heart to know that even if Forex was denied, say something happens, there's a global reset. Okay, we're going to take an extreme leap into the tinfoil hat bin, and say that there's a global reset, the dollar collapses, all of the foreign currencies collapse, and they create a one world currency. And it's a cryptocurrency. I'll even go so far as to say that. I'm not believing it. I'm not saying that. I'm just putting that out there as a hypothetical, just to make an extreme argument. Even if that's the case and that happens, okay, great. I'm going to go back to trading index futures. It's no big deal to me. I don't have to be a Forex trader. I don't have to be trading the things that other people are doing, because everything I'm teaching you, it gives you freedom. It does not limit you. You are learning price action to the highest degree that will allow you to go into any asset class and say, I'm going to carve my career out here and not be dependent on a job. Right now, look around, folks. Really take a step back and just take it all in. We have seen so many things come out this year. Okay? We had a pandemic, a killer virus that didn't really kill that many people. We shut down economies. We shut down businesses that are probably never going to come back. We locked people in their home, lowered their immune system, killed the economy. Now it has this war between people that wear masks and believe everyone else should have a mask on, and those that don't want to wear a mask and think that people wearing masks are nuts. So you have division there. And it didn't create enough civil unrest. So what do? They go right back to the race baiting again. And I'm not trying to diminish anyone's life being taken away, but everyone's falling for the trap. And it's always division, division, division. Because they saw everyone rising up again in China. So what do they got to do? Create another distraction. They record a cop that makes no attempt to hide what he's doing. And it is recorded. Any other time a cop saying, get that camera off me? Nope. The Asian police officer was right there making sure he was out of the way so the camera shot could be taken. It was all meant to incite everything that's going on right now. This entire world heard our military confirm the existence of unidentified flying objects. Now, I'm not saying ET exists, but they're saying that they've seen and encounter video documentation of things that move faster than them, and they don't know what it is. They released that to the public. Any other time, the public would have been going nuts. But because everything else that's going on, they dropped it in there, say, well, we told you they existed. So later on, if something happens, they're off the hook. Hey, we told you it existed. But everything that's going on, okay, everything that's going on this year has been a whirlwind of confusion, fear, uncertainty, loss. People have lost their jobs. I have people in this mentorship that are paying out of their savings because they know what they're learning here is going to provide a inflation proof, a pandemic proof form of feeding themselves and their family. So when you learn about index futures here, and you signed up with, because I'm supposed to be the Forex guru. I'm not the Forex guru. I'm the price action dynamo. I'm the guy that knows how to go into any of these asset classes and find the opportunities. And that's what this mentorship is. It's teaching you those skill sets. So when you see this SMT divergence on the index futures like this, know and trust that it happens every single week. And you can get your one shot, one kill, your 1 pound of flesh trading index futures. You don't need to trade a lot of different things. Just one little thing that lines up with what I'm showing you here. If it looks like this, then it's probably a signal. It's probably a setup. Okay. But what I'm looking for is the standard things that you've seen me teach you in Forex. I'm looking for a run into liquidity. If I'm bullish, I want to see equal lows be purged. And then some kind of supportive evidence. So what would that be in Forex? If it's trading down for the British pound below relative equal lows and I'm bullish, how do I know that it's not going to continue going down, Michael? Well, I'm looking at the dollar index to see if there's an SMT divergence between the USDX and the currency I'm looking to trade, or if there's a correlated pair SMT divergence between cable and euro. So euro should have made a lower low, whereas cable made that higher low, but still below its relative equal lows. In other words, looking at this E-mini S&P here, say this was the British pound, okay? And once we go below these relative equal lows here, if it trade down into a bullish order block, then I would expect to see a failed higher high in relative terms here on the dollar index, or this low being higher or different, let's say it that way. The euro dollar may have not made a lower low, and that confirms it was just simply a run below equal lows to get the liquidity, and then it's going to move up. And in the euro, that might change my mind. If we created a higher low in euro than we do here, even though this is a setup buying a sell side liquidity pool and then trading at higher relative to a weaker dollar, I may change my mind and say, okay, even though I was stalking cable, the price structure that's in euro dollar may change my mind about trading long euro versus pound. So that's the normal process that goes through my mind when I'm looking at charts. That's when I go through those types of questions internally. That's the internal dialogue I have. But when I'm looking at index futures, what I'm looking for is all the things that I have taught so far to you. The PD arrays, order blocks, market structure, fair value gap, working with order block and breaker and mitigation, and then looking for low resistance liquidity runs. If I think I see a setup there, I will not take that trade unless it has this signature here. One of these index futures has to say, no, I don't agree with that. And you see that here with the Dow. We have a higher low here, lower low in the S&P, lower low in the NASDAQ index futures. So what is in play? The run below these equal lows for the sell side liquidity, buy up those stops, send it higher above the relative equal highs that has the lower to the right. Notice it's lower here. So it's a very easy low resistance liquidity run. Okay, so I want to take this off and kind of walk backwards through this and show you the scenario. So this is what the chart looks like without all of that other lipstick. And the way you get that on your chart, in case you're wondering, in one trading view, right about in here, you can't really see it because I have everything just recording just to the top of the box here. So just north or right above where I'm pointing, you can't see it, there's going to be a circle with a little plus symbol and the word compare. When you click on that tab, this is what pops up. So if you ever want to pull up a index future SMT study, load the E-mini S&P. Right now we're looking at the ESM as in Michael 2020. That's the symbol you put up in there. And then once that's there, and we're getting ready to trade into June. So eventually this coming month in June, the June contract will expire and then we'll move to September SPOOs. So September contract month is the letter U, like umbrella. And you would use ESU 2020 for the E-mini S&P futures contract. And then where it says June here, it'll say SEP for September 2020. But whatever you're using for the index future, like this here, S&P E-mini for June contract, the symbol for June is M, and you would load up Y, M, letter U for September 2020, which is the year. Okay, and then you would just click on this, and then it would add, there's your symbol, and that's your Dow, and then you would use NQU 2020. That's the NASDAQ E-mini futures for the contract month delivery of September. Click on that, and it adds it there. And you can just click on it and change it to whatever color you want it to be. But I'm not keeping these on the chart because I already have the June contracts comparatively. And then you could just see where the SMT divergences occur. And you'll see all the turning points have to agree with the indices. And if they don't agree, then you're seeing a crack in correlation. And there's underlying distribution where we have the higher high here. We don't see that in the Dow. We do see it in the NASDAQ. So what happens? The market trades lower. What is it doing? It's taking the sell side liquidity out and trading back down into a discount. Market's making lower lows here. You see that? It makes a lower low in the Dow, but is it doing it in the NASDAQ? No. And then we had that rise on Friday. So it allows you to see with an X-ray view when we are looking at things that would otherwise give us an inclination to be bullish or bearish. It gives you the X-ray vision of seeing whether there's real accumulation or real distribution in the marketplace. So to me, it's just a phenomenal way of deciphering price action and giving you a real underlying perception of the buying and selling of smart money trading. All right, so let's move out to an hourly chart on the E-mini here. And you can see this blue box, that is that volume imbalance that I talked about for months now for the E-mini S&P. And these levels here are a daily bullish breaker. This is the high end of it, and this is the low end of the breaker. And you can see we had a market break higher, rebalance to a bullish breaker here, sent it higher. Look at the run here. Remember I was teaching you already. We have what? A lower high here than here. So while this is relative equal highs, this is a easy or low resistance liquidity run that has no problem trading through it. Look at this. We have a higher high to the right than we do here. Are these not relative equal highs? Absolutely. But look closer. Fair value gap. See that? Draw that out in time. Bam. What does it need to do? Retrace more before it takes this relative equal high out over here. You see that? Look at this. Here's the low and the higher low to the right. So when the market's trading down, it's going to run through that easier than it would be if this low here on the right was lower than this one. But because it's higher, it's creating a much easier low resistance liquidity run to be rated and traded through. Lower high here relative to here. So this retracement down, how do you know it's not going to keep going down, Michael? Because the breaker's there and we made a lower low than the previous low. It's already done the rejection here, whereas we don't do the rejection here before dropping. So it's unfinished business. So you've heard me say this in recent months in tweets, or maybe hear me make a remark about it in my commentary. What is unfinished business? It's a term that I use as what I just showed you here. Unfinished business is this: when we have a lower high to the right with relative equal highs, or a higher low than the lower low on relative equal lows. So there's unfinished business down here, there's unfinished business above here. And wherever the dynamic is on the market for bullish, then it's going to run to this one and to do it with relatively easy, no real difficulty getting through it, because it has the lower high to the right. Okay, so it's very, very important that you understand that signature, and you can see it in every asset class. I've even seen it in Bitcoin. So it doesn't make me want to trade crypto. I'm just saying that these are some of the things I do see, but this is one of those lessons that are very, very deep. Okay, they're very dense lessons. And when I first introduce an idea like this, it plagues the new trader or the students in here with 1,000 different questions. And you're probably already starting to type up an email to send to me. Resist doing that. Resist doing it. Number one, because I'm backed up like crazy. I have questions literally 7 weeks old that I still haven't gotten into yet. So give me some time to get through some of the block of emails I got now. I can only get through about 350 of them a day, and I'm not doing it anymore on Saturdays and Sundays. So it's just so many of you, and you just got to give me time to get through it. But I'm telling you not to email me, because you need to go through the charts and start studying all the turning points. Like, this is a turning point, 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 that's a turning point, this is a turning point. And every turning point, study, was there a single high or relatively equal highs? And at the highs, is the high to the right higher or lower than the one to the left? And think about what I taught you here, because it sets the stage for a real low resistance liquidity run versus one that will still likely be rated and traded through, but may need a retracement ahead of absolutely going through it at a later time. All right, so let's go out to a daily chart. All right, so here's the daily chart for E-mini S&P, and this is that volume imbalance. I said if we traded through it and out and come back down in, which is we did here, look at the bodies. It stayed within the volume balance. Here we only went up into a little bit above consequent encroachment. This time we went out of it with the bodies and back down in. I said, and go back and listen to the commentaries, I said if we did that, then the volume imbalance would provide the catalyst for a bullish move to the upside. Now, if we see a sustained run, say that this is just a knee-jerk reaction, and it might not be. It might be a more sustained decline. That I don't know. It's still Sunday and we just opened up. So I would be looking for signals to form on the basis of bullish institutional order flow on Monday and Tuesday to see if we start to trade higher. Should we do that above this high and then into this fair value gap would be the likely expectation for near-term bullishness for E-mini S&P. Now, if you look at the high here, okay, we have a low, the high, and a lower low than here. That's a breaker. That's what I'm defining here, okay? And if we drop back down into the hourly chart, notice that at that breaker, at this line right here, we have a run below this low here, then we run. We create a fair value gap. Fair value gap with a higher time frame bullish breaker, high probability. And also, this run to here, if you go down to a 15-minute time frame, that's an optimal trade entry. Rallies to a bullish order block, rallies, breaks down closed candle, rallies. So everything in here, bullish order flow, okay? And we have relative equal lows. It trades down to clear the lows, rebounds the BISI, bullish order block, and this is where that divergence between the Dow and the NASDAQ. The Dow failed to make a lower low here as we hit a fair value gap with a bullish order block, and we ran above these highs. So this is where you can see old resistance broken becomes what? Support. Now you know when it works. You have to incorporate all the things I'm showing you here for institutional order flow, not just simply old highs broken, let's trade back down to it and find that as a buy, because I can show you a plethora of failures of that. You'll be hard pressed to find the things I'm teaching you here constituting a failure of this idea, because it's hinged on the underpinnings of the marketplace, the real things that make the markets go up and down. And you can see the underlying accumulation and distribution when you look at the relationships between the Dow, the NASDAQ, and the E-mini S&P. Factoring also the elements of the order block, market structure, all those things, it just makes it so nice to be able to trade index futures with this insight. It's not going to stop working. It's been like this forever. Okay, when I was starting in 1992, I wasn't interested in S&P. When I hear people talk about S&P, I was like, I don't want to do that. It's stuffy. To me, it felt like a snob market. I don't know how to explain it other than that. I just felt like only the goody two shoes was trading that. And there's a reason, because it's very, very organized. Even though it may look chaotic to people that are first time introduced to it, it is a market that is just a real pure market. It's really nice. You can clearly see the manipulations. Even in all, I mean, for instance, look how accurate this year has been for me, talking about the S&P and calling the crash, the day before. Come on. It's predictable. It's very predictable. So I don't introduce this and just say, here's some extra fluff and filler. This is real stuff. This is real insight that you can go out and you can carve out an enormous career with what I'm showing you here, just in this video alone. The signatures that I'm showing you exist in all of markets, but when you rely on the SMT ideas with the things I'm teaching you in market structure and order flow, it just makes it very easy to see what the institutional traders are doing and even anticipate before they do it. Like you can see these guys talk. I'm looking at volume profiling, and I'm looking at the DOM, the depths of market, and I'm gonna do this and I'm gonna do that. All that stuff, okay, all that stuff is just gimmicks. There's no real anticipation of that. Like you have to look for a point of control, or all these things, and you got to weigh out how much you want to do at this level or that level. I don't need to do that. I know what levels should create an opportunity because look, there's an imbalance right there. I don't need a volume chart to show me that. I don't need to see a volume bar be very small here to know that that wasn't a lot of trading there. It's a BISI, it's a buy side imbalance. I don't need anything over here on the vertical side of my chart to show me that that is an area to look at because of price. It was inefficiently offered. So what does it need to do? It needs to offer sell side. Think about what I just said. They're looking at bars over here that depict volume, and they're looking for relationships between the highest volume bar and the lowest volume bar and the point of control and all that stuff. And honestly, it's all gimmick. You're just taking the same things that's been applied to trend lines and divergence and indicators, and you're applying it to this over here and saying, okay, look at this. This right here is saying this. We've always had volume. This was always vertically down here. But to make it look like it's something new, let's put it over here. Well, you don't need that. You can be a visual trader and just say, okay, I see one candle. And this one candle painted in between a range between this candle's low and this candle's high. So there's something special about this candle. But what is it? It's easy. It closed up. So what did it do? It created a buy side imbalance. It only went up, and it went up in an area where only one little candle supports all of this price action, and finally it breaks down and closes right back to the candle that was down before this up candle was formed. So all of this green candle, think about it as a paint roller, okay? And you put paint on the wall, all the chart where it's white, that's the wall, and you apply the paint here to the wall going up, and it keeps on going. Are you going to have a lot of paint on your roller still as you start painting up like that? No. So what does it need to do? It needs to come back down and fill in all those little pockets that where the paint didn't really efficiently be applied to the wall, where it was really thick here. It needs to come back down and offer what? The downstroke in that same little area. So that's the analogy I use with rebalancing. Okay, so the BISI or buy side imbalance, every single up close candle that can be encapsulating a specific price range, the candle's high here, and the candle's low here, that little area right in the middle, that has to be at some point in the future needs to be traded with a down candle. Every price range, every single price range on any market to be efficiently delivered and modeled for liquidity has to be offered on a buy side and sell side delivery, period. End of story. That's what makes markets go up and down. Now, you have internal range liquidity, which is what this is here, between this low and this high. But it also operates in the capacity of external range, between this range low and this high. And when you can see both sides of a liquidity pool like that, you have a strong liquidity pool that creates what? An explosive price action move. You have a range from here to here and a range from here to here. By itself means absolutely nothing. Sounds like hindsight gibberish. But in the mentorship core content, I teach you the idea of external range liquidity and internal range liquidity. These relative equal lows between this high and this low, or these lows, outside of that range below it, this would be external range liquidity. But it also is the low to high internal range liquidity. So it is a double barrel shotgun. You're getting a large pool of liquidity being tapped into, and that's what makes these moves extrapolate to the upside. Go back and look at your charts. When you can frame what I just said, and listen, go back and rewind the video a little bit and hear me say it again, because there's no plainer way for me to say it. I teach more of it in the core content, but when you have an overlap of both a area of liquidity where below old lows, it's external range and internal range liquidity, and then you see these extrapolated moves. Couple that with the SMT divergence that I showed here, you have $1 million trading system. Just like that. Just like that. It's simple. It's very, very simple. But now imagine being your first day here, and some of you are just now starting, and you're hearing me say these things. You're like, what? Internal range, external range. Your head's swirling right now. Trust me when I tell you, the people that have been here up to month 5 or later, they're smiling because they understand what I'm saying. They understand the things I'm saying. The new folks that are coming in, you are experiencing the same thing that the other people and the charter members have experienced too. Like, okay, this is too much. I need you to answer this. I need you to answer that. You already have a laundry list of questions you want to email me. Don't. Write them in your study journal by topic. Do topical studies, okay? And literally, as you go through the core content, those questions get supplied to you in the form of answers. And everything you're wondering and worrying about right now, they are not imperative at this moment. There's other things that you need to learn. Trust me, I know how I'm doing, and I know I've done this with thousands and thousands of people, and the people that get it are the ones that submit. It ain't me going to you and answering every beckoning call that you give me in an email. Okay, it's not me pushing you away. It's not me saying that you're not important. It's me saying you subscribe to this and you're part of this community. You're going through the growing pains of learning how we communicate. And until you learn that language, which is completely all the way up to when you become a charter member, then you're able to be part of the community and you can interact with other people. But you will not learn anything unless you keep a study journal and then go into the charts and study the things I prompt you to. Look for these things. I'm telling you. The relative equal highs and equal lows lesson I gave you here tonight, and then incorporating external range and internal range liquidity and the SMT divergence with the index futures, it is a bombshell. It's beautiful. That's the secret recipe. That's your blue ribbon recipe for trading index futures. And you will literally destroy any of those guys on YouTube. Anybody out there running subscription-based signals, what I showed you here today beats the living hell out of all of them. They can't trade that way. They don't even see it. They don't even know. Well, of course, now they're going to know it now. But it ain't going to change anything. It's not going to change anything. And these are just one or two things that I showed you in this video. There's dozens more that you're going to learn in core content, and there's dozens more beyond the charter level, content that I've already given. But you have to grow into what you're being introduced in the natural progression through the core content, and in growing in your expertise and understanding of what it is that you're learning. It's not enough just me talking about it. It's not enough me saying this is what it looks like. You got to go into the charts yourself and find these things, and you'll see. It's not me just going in cherry picking things. They're there all the time. It's like this all the time. And when I discovered this by studying hours and hours and hours of data every single day after it happened, because I was working a job, I needed to know, was it like this before I started on November 5th, 1992? November 5th, 1992 at 9 p.m. in my aunt's family room, dark and dingy with wood paneling on the walls and one lamp with a 60-watt light bulb illuminating the first book I ever wasted money on. That was Ken Roberts' course that taught me nothing except for how to lose money. 50% my first trade. Just like that, gone. You can't rush into live money. But I looked at all the things I was learning. And in 1993, I was literally going and purchasing data that was decades before me. And I needed to see if what I'm finding, okay, am I seeing things that repeat even before I was born? And they're there. They're there in the agricultural markets. They're there in the metal markets. They're there in stocks. It's in the bond market. It's in commodities of any capacity. And now, with the emergence of crypto, I'm seeing these signatures appear there as well. But because it's such a new asset class, I'm not in a hurry to trade it, folks. Now, I know some of you in here do. Congratulations. You have more bravado than I do. I just don't understand it enough yet. When it has all the signatures that I see in all the asset classes that I've traded, then I will consider it, but I'm not considering it until I see it. And there's other things that you haven't learned yet that I'm looking for in price that crypto don't simply show me yet. Assets like the foreign exchange market, spot and or currency futures or commodities or index futures, those markets show them all the time to me, and I'm comfortable. I know them well. And anyone that says, I know cryptocurrency like the back of my hand, well, I don't believe that, because it's squirrely. It does weird things. And for some of you grow into that affinity saying, yeah, I like it because it's like that. And later on, you may discover, once you understand it better, and if it picks up more of the things that we like to look for here, then you'll look back and say, man, it really wasn't trading like you will be learning how to see price in this mentorship. At a later time, if it does evolve into what it should, if it's going to be a viable asset class that's going to be around for a long time, it will eventually pick up these signatures, because it will be manipulated. And everyone in here that thinks that that's never going to happen, it's going to happen. Okay, the people in this world are greedy, and money talks and BS walks. And if there's a lot of money invested in something, someone's going to have the most, and they're going to manipulate it. It doesn't change. It's the way it is, folks. This is a prison planet. Everyone's a slave here. Okay. And you either figure out the system and work within the way it works, or the matrix, if you want to call it that. It is just that simple. You can't beat it. You cannot beat this system. You can't. You either have to get in line with it or get destroyed by it. It's that simple. But it's very hard to come to grips with it, because it's absolutely 120% manipulated. And right now, crypto is just getting to the point where they're getting their claws into it. And if it's literally going to be around for a long time, it will absolutely be manipulated to the degree like this market is in front of you, the index futures, just like the foreign exchange is. And if it does, then I'll run roughshod over that asset class too, and I'll be known for the guy in crypto, whereas I'm not now, because I'll be doing things that are phenomenal in that market, like I've done in Forex, futures, and commodities. I'm not impatient. I'm waiting, because I know what my content can do in a market that has these signatures proving the people I came from, they're going to be in control of it. You can shake your head no all you want. Oh, it's decentralized. Oh no, it's this is that. Listen, folks, they have a futures contract on it. Okay, that's not because it's random. They're ringing it in, and there isn't a whole lot of volume on it. If you look at the Bitcoin futures, it's really low. But anyway, I'm rambling. I feel guilty because I was working really hard to get connected to the internet today, and the whole time I'm sweating bullets. I'm thinking, man, what if I don't get these videos done? I don't ever really miss a delivery on mentorship, not on the weekly commentary. I'm delayed sometimes with charter stuff, but that's going to have to happen. And so tomorrow morning, I'll work on that and get it up by 2-3 o'clock tomorrow afternoon. So if you are a charter member, just know that you won't get your Model 5 trading plan until tomorrow afternoon. But I think that's going to be it. We're not going to talk too much more. I gave you a lot to chew on in this lesson. I gave you a lot to look for and study in your charts. And there's going to be questions, I'm certain. But write those questions down in your study journal. And I promise you will get to a specific level in 1 month or maybe several months in the future from where you're at right now. And you're going to hear me talk about or teach a lesson that will unlock the question you're having right now. And you're going to see that, wow, I didn't need to know it back when I thought I needed to know it. And now that I understand it, I have 15 other supportive lessons that I didn't even know I was going to be learning about that makes this understandable. And that's the reason why I give 99.9% of the time people emailing me saying, how do I know, or how do you know when price isn't going to go above an old high? Or if it goes above an old high, how do you know it's going to stop and go the other direction? It's lessons like this one. And it's not an easy lesson. It's a lesson that you have to come back to several times. You got to go into your charts and see it, and then it'll click. You'll say, oh, I understand it now. Not because you heard me say more things, but because you heard me say everything that's necessary in this video. But now you got to go into the charts and see it yourself. And the way you can see a lot of examples of it is, again, like I said, the 15-minute chart and the hourly chart. over a span of an entire month. And you'll see what I just said in this video is true. And the things I talked about for the index futures, it's every week, folks. It's absolutely every single week. If you have a bullish expectation for the weekly range on the index futures, because that's where all of our models start, all of the price action models, except for the really, really ultra scalper ones who don't really require the weekly range one. But if we're doing like a day trade range, or a short-term trade, or a one-shot, one-kill, or a swing trade, they all are banking on what is the weekly range going to do. Is it going to expand higher or lower? It doesn't necessarily need to close high when we're bullish, or it doesn't need to close low when we're bearish. It just needs to offer an expansion in that direction over the course of a few days of that week. And if you're able to determine what the weekly range is going to be, bullish or bearish, for the coming week for index futures, then all you do is look for what I just showed you in the SMT divergence and couple that with other things with the market structure. And now also look for areas where we can see if we're bullish. Look for areas where it could be a external range liquidity running below that, and by running down there, it also becomes internal range. So you're getting two camps of liquidity pooling, okay? It pools together. This is, I'm not going to tell you what I call it, because again, it's charter level stuff. They haven't learned it yet, but it is this element where it's external range liquidity and internal range liquidity together. Then you get these high energy moves. How do you know when the market's going to create explosive price action move? You just got a secret recipe right there. You don't find that in my free tutorials. You don't see that in other people talking about, and you don't see it. I gotta say, this is it's eating at me. There's a guy that's supposedly been around, he says he's been out there longer than I have. Not that he's comparing himself with me, but he says he's been out there for 30 plus years or whatever. And he's taken my fair value gap and calls it a gift zone. Unbelievable. The guy only scalps for like a minute and gets out and claims he's an amazing trader and shows a lot of high balance accounts and supposedly this and that, and I don't get it. It's just, and if you know what you're doing, you're going to hold longer than a minute and just try to catch 20 ticks or 30 ticks and think that's a big shot win. Can you tell I've been wanting to talk? I got a lot of stuff on my chest I want to get off, but nonetheless, there's a lot of people taking what I've been releasing and renaming it. And there's a couple people on Facebook I'm getting ready to go after as well. The banker's strategy, which is nothing more than my pirated mentorship being renamed under some gimmicky crap. But the lessons that we got coming in June, I'm going to work more in the commodity sector. So we're going to look at like meats and agricultural markets, just again to give you a broad brush overview of how diverse my concepts are, and getting ready for what I believe next year. Okay, all this stuff with the economy, the food, all that stuff, that is setting up an enormous potential for crazy bull markets in 2021. And you have plenty of time to learn. And I'm going to talk about, we're going to go into options, and we're going to look at how we can use options to use very, very small amounts of capital. And hopefully, if we get these big extrapolated moves next year, because of all this buildup, all this shortage of food that's going to be coming, and it is going to happen. Right now, it's not a big deal because restaurants have been closed. And all the grains and all the meats and stuff, they've been killing them because they can't bring them to market because the consumption level has been reduced. No one's going out to restaurants. I mean, now it's starting to come back a little bit because they're doing slow openings of the economy here and there, but they haven't done a full opening. And if it was a full opening, then the demand for all these foods and such would create a premium in those markets because they have already tilled in the grains in the ground because they couldn't take them to the market and use them on a grand level. Only consumption has been through grocery, and grocery is delivered on just-in-time business model. You only got really like a 3-day supply of food. And that's why it's real easy for these grocery stores to run out of stock. Next year, because of everything that's going on, we're going to have real problems. And markets like soybeans and wheat and corn, they have the potential to do some really crazy runs higher based on the underlying fundamentals that are in play right now, but the demands aren't there yet. But the demand will come, and the uncertainty of whether we're going to have enough to meet it is what's going to cause these markets to go crazy. And to me, I just think it's something that we need to be aware of and start preparing for it now. And you don't need a whole lot to do well. Like, you don't need a whole lot at all. And even buying out of the money options, while in other times it would be otherwise viewed as gambling, but in other instances when there are markets that reverse and they start getting more expensive right now versus in the future, which is a normal carrying charge market in the commodities, like for instance like soybeans. If you look at a delivery contract for soybeans right now, it's July. And if you look at that price and you look at November beans, if you look at that, there should be a higher price in the latter month because there's more costs of storing, raising, producing that commodity. If it ever reverses and it's more expensive right now on the nearby contract and you're trading the commodities, that is an inversion of the normal carrying charge market. And it now has become a premium market, not to be confused with what we refer to as a premium market where it's up here relative to the low down here. This would be a premium relative in that range. I'm saying it's a premium in the sense that the nearby contract is selling at a higher price than the distant months or the next month out. So whenever you see that inversion of that price structure indicates that the commercial users are scrambling to get whatever they can get right now, and they're willing to pay a premium price for it. And if you have that, and you have the backdrop of what's going on right now as we go into the fall months, it may even occur in the fall. Like, we may have real setups then. So again, it's just, there's a lot of things that are potentially on the horizon that could really set up amazing mega trades. And it's something that I've been chomping at the bit to do because the commodity markets have been really quiet lately, and it's due. And we have all these problems right now in the world, not just in America. It's everywhere, and people are getting sick and tired of it, and it's just going to be used as a weapon. Food is going to be used as a weapon. Understand that. If you have not got your house in order and you don't have at least 6 months of food supplies, that means even if you don't like it, and everyone agrees that ramen noodles is not healthy for you, but it's cheap, and it'll take away hunger pains, it'll fill your belly for a little while, and it's just last resort rations. It doesn't cost a lot, and you can go to the grocery store and you can find that still. 50-pound bags of rice, okay? Things like that. You want to be, every week you should be going out and getting yourself a 50-pound bag of rice and just putting it aside and putting it aside. Put it in a 5-gallon bucket, brand new. You can go to Home Depot and get a couple 5-gallon buckets with the lids and keep it in the bag and put it inside the 5-gallon bucket with the lid, snap it closed, and just put it aside. And I'm telling you, everything to me looks like the coming months and going into the fall and winter, we're really in some trouble. I mean, we could really be facing some real food price problems and supply. And I've tweeted it too. If you haven't already got your shoes in the U.S., try to get them. Try to get a couple pairs, because I can't tell you where I'm getting it from, because it's just being pressed on me to tell you. And it's the same thing I was telling you back in the first week of February. And I said, look, this is what you got to start doing. And what I felt back in last summer when I said something wicked's coming. And I don't know how to articulate it other than just simply I feel like I'm supposed to say it. So I say it. And I'm just going to leave it at that. Okay, so it's up to you whether you want to do anything with it. To me, it's just common sense preparedness, and it's not, tinfoil hat. It's just making sure you have and your family has what it needs. And whatever you buy on a normal, if you can afford to, get a little bit more of whatever it is, like soaps and shampoos and toothpaste, I would do that. And don't think of it as you're hoarding. Just Every time you go to the store, get that one more time. And you may not be able to afford it. I understand, but it's things like that you need to do. In closing, I'll say this. We're going to see a lot more of what's going on in the U.S. It's going to go into every state. George Soros is behind it. He's actually going around and he's paying people to protest. And there's if you look hard enough, you'll find video footage where you can see the people actually paying individuals to go out and do these things. You also have provocateurs that are inciting more of the violence and stuff. And that's all designed. It's all designed. And it's meant to sway the vote. I believe that Biden is holding off who he's going to run with. There's some people that have said Michelle Obama, Hillary Clinton, or it's definitely going to be a female. And if he wins, then you're going to have a female president, because Biden's going to have to step down. He's not well. He doesn't have all his faculties. So if he gets elected by hook or by crook, if he gets in, whoever his vice president is, that's going to be the president. And I will say this: if Biden happens to say Michelle Obama, while I think that is absolutely unrealistic, he's going to win. I think that would put everything over the top, because they can see it. Anyone with common sense can see that Biden is not in his right frame of mind. He's ill, and it's unfortunate that they're using him to get in here. But they can backdoor this whole process and put a female in there and run as a vice president, and everyone would see Biden, the Democrat, beating Trump. But the real narrative is use Biden to get in. Biden's sick, he has to step down, and whoever the female vice president is becomes the president. So yeah, it is likely to do that very thing. That's what I think is personally going to happen. There's so many things stacking against Trump. I said this in 2016. I said, I like the idea of him coming in because he's not a politician. I want to see how he does getting in there and unsettling the status quo. Does he change? Can he change anything? And you saw there was opposition everywhere. And I'm going to be honest and tell you this: it does not matter who you put in that White House. If you're not going along with the globalist agenda, you're not going to be successful. Period. And I'm not taking out for Trump, because to me, I think he's a vile man. But I was interested to see what he was going to do. And you go back and you can listen to my discussions in 2016. He's the perfect fall guy. Who else could have caused the economic collapse, the highest unemployment rates, the failure to save everyone from this virus? Come on. I mean, the guy has had everything stacked against him. He's not a role model at all, but he has been met with so many things that personally, if he wins this election and say the GOP gets the Senate and the House and Trump gets elected again, then only then will be a test of whether or not he's going to be doing the things he campaigned on, and if the presidents can really do what they want to do in terms of correcting things in this nation. So it'll be interesting to see what happens. Either way, I personally think, we have hardships, because if he gets the election again and the GOP gets the House and the Senate again, the left is going to go nuts. They're absolutely going to lose their mind. And you're going to see a whole new level of crazy madness. And, here's the end result. We will see martial law, period. End of story. By next year, this time, and probably way, way sooner before we can get to the elections, we're going to see martial law. It's the way it is. And I think it's just weird that we're supposed to have a presidential election. There's no real campaigning. There's no real, look, this is what we're going to do if we win. I mean, doesn't it feel weird? Like, what's going on here? It doesn't feel natural. Something doesn't feel right. It's almost like they don't want to be bothered with it because something else is going to prevent the necessity for campaigning and releasing who their running mate's going to be for Biden. Like, it's just weird. It's, in the time of this recording, maybe news came out and said, I don't know. But as of right now, I don't know who his running mate is for vice presidency. And Trump really hasn't said what he's going to do if he gets reelected. It's madness right now. So anyway, that was, I kind of left all that to the end of the video because I know some of you don't like to hear it. Some of you love Trump and some of you hate Trump, and I'm indifferent. Like, I don't really care one way or the other, because ultimately whoever you put in that office, they're all going to be put on strings, and they're not going to be able to do the things that they campaign and promise they're going to do. I used to believe they lied, and then when they got in office, they changed their mind. I have since changed my opinion about that. And not just recently, it's been decades ago that my mind was changed. When you get into office, you're told basically this is what you're going to do. And if you don't, this is what's going to happen. And it sounds like tinfoil hat. And I'm sure there's a lot of you who say there's no way it's like that. And you're entitled to your opinion, and I'm entitled to mine. And I'm asked in email to share it and tell you, and I just did. So, like I said, it's going to be madness. We're at the Wild West right now. Just like in 2016, I said they're going to crash the economy. They've done it. They're going to say he did all these things, so that way no one ever outside of the politics inner circles will be allowed to be president again. They took risks when they let Reagan in. And here we have Donald Trump, which is the farthest extreme in terms of, wild cards. And then look how much of a circus this has been. Like, it's been nonstop drama. And the way he has conducted himself in social media is not becoming of a United States president. I mean, I'm just going to say it like that. We are not in the WWE, okay? And there should be a higher measure of conduct that the presidency just demands. We should be looking at this individual with respect and trust that he is maybe making very difficult decisions, but he's doing so with the best intentions for the country, for the people, and for his party, in that order. And I have not felt that from Donald Trump. I didn't feel that with Obama. I felt his first year, it was great. It was time for us to have a black president. It was time for us to show the world that, black men or women could excel to that highest degree in terms of being the president of the United States. But after getting in office, I was not impressed. In the second term, I thought it was dismal. And no one's perfect. And there's a lot of problems in our country, just like everyone else's country. But in our country, we have guns. And in other countries where things get sour, you might go out there and protest and push over cars and wear yellow vests and scream and get ugly and throw rocks or whatever. Here, it becomes a shootout. And it's much more dangerous here. And that's why I said here in the U.S., we're going to see some things that you're probably not prepared for. And it's probably going to get scary. And it's probably going to be unnerving and unsettling. And the only thing you can do is just prepare for you can't change it. You're not going to stop it. So the only thing you can do is prepare you and your family and do what you can. And just avoid the risks of being around all that stuff. That's all I got for right now. So I'll talk with you guys by way of Twitter, I'm certain, tomorrow. But it won't be until after I get the charter membership video together and post it for them. Then I'll start chattering, because I have something to do prior to that tomorrow morning. And then we'll be back to normal, where we talk about whatever we talk about on Twitter. And I'll talk with you by way of midweek review on Wednesday. So until then, be safe and good luck and good trading.